Hey guys, welcome to Investify, where we help you grow your wealth through smart investments. Today we will talk about the Federal Reserve's pause because of economic troubles in real estate and banks. This move reflects a broader evaluation of the economic landscape, considering factors beyond inflation. Why? Well, it seems the real estate and banking sector are causing some economic jitters. Inflation rates are playing a game of now you see me, now you don't, with prices still itching up, albeit at a snail's pace. Join me as we unravel the reasons behind this Fed decision and dive into the hilarious world of economic troubles. From rising prices to banking woes, we'll explore the wild ride that led to this pause and its potential roller coaster effects on the economy. Fasten your seatbelts, folks. It's going to be an unpredictable journey full of surprises. Hang on tight as we uncover the secrets of the Federal Reserve's quirky decision-making process and its impact on the financial landscape. Let the laughter and insights commence. To enlighten you with some intriguing insights into the Federal Reserve's decision on interest rates, you see, they're not keen on being too aggressive with their policies because that would only add insult to injury for struggling sectors. Imagine if they raised interest rates today. Oh boy, that would squeeze commercial real estate and regional banks like a lemon on thin ice. We all know they're already cracking under pressure, so why push them further? The burning question remains. How much more can these sectors endure before something snaps? Now let's dive into the three key areas of concern before circling back to the Federal Reserve. First up, we have the captivating world of commercial real estate. Thanks to the ever-prevailing work-from-home trend, office vacancies are skyrocketing. And guess what? When tenants refuse to renew, it becomes a Herculean task for property owners to pay their mortgages. It's a losing game, my friend. But wait, there's more. The plot thickens when commercial property owners need to refinance their debts. Higher interest rates? Talk about a party pooper. In their Epic Financial Stability reports, the Federal Reserve stated that the sharp rise in borrowing costs over the past year increased the risk of commercial mortgage borrowers being unable to refinance their loans. Here's a mind-boggling fact. Many of these property owners took out loans when the Fed funds rate was a measly 0.25%. Fast forward today, and the Fed funds rate has skyrocketed to 5.25%. Talk about a roller coaster. But hold your hats, folks, because things are about to get scarier. Here's a hair-raising revelation. A whopping $1.5 trillion of commercial real estate debt needs to be refinanced in the next 3 years. Yes, you heard that right. And this year alone, we're looking at a jaw-dropping $450 billion worth of refinancing obligations. According to the estimations of the wise JP Morgan, a staggering 20% of these loans could default. So it's crucial to understand the intricacies of these alarming developments and their potential impact on the delicate dance of the Federal Reserve. Stay tuned as we continue to unravel the mysteries that lie within the world of economics and finance. Morgan Stanley predicts a potential decline of up to 40% in commercial real estate prices. This factor likely influenced the Federal Reserve's cautious approach, avoiding aggressiveness in their actions. By taking a pause, they aim to provide the economy with some breathing room before deciding whether to increase interest rates further. Number 2. Shifting our focus to residential real estate. Although it appears to be in relatively better condition compared to commercial real estate, there are still concerns. Home prices have dropped 5.2% from their peak, showing a 4.1% year-over-year decrease. Additionally, real estate transaction volume has fallen by 25.8%, partly due to higher mortgage interest rates, which currently average around 7%. Lastly, the instability of smaller regional banks is another point of concern. In the past, these banks profited from mortgages with low interest rates. However, with changing times, they are now compelled to offer higher interest rates to depositors, impacting their profitability. It's important to note that this situation does not apply to larger banks that continue to pay their depositors minimal interest rates. In addition to the challenges faced by smaller banks, they are also burdened with over $700 billion in office building and downtown retailer loans. The reality is that these banks are struggling in a higher interest rate environment, which impacts their operations. Furthermore, if commercial real estate experiences a decline, the banks will suffer significant losses from the assets they hold. Most of these loans are held by smaller banks. Raising interest rates is a tactic employed by the Federal Reserve to slow down the economy and reduce inflation. However, this approach comes with trade-offs such as lower wage growth, higher unemployment, and lower GDP. The Federal Reserve aims to strike a balance and avoid overdoing it, which is why they opted for a pause in raising interest rates. The US GDP growth rate has been declining, with consecutive quarters showing a decrease. The economy is clearly deteriorating, and it is important to highlight this as it may not receive much coverage in the media. Government spending has been propping up growth in recent quarters, but with a cap on government spending and anticipated reductions, it is expected to act as a drag on the economy in the coming months. The conference board predicts that economic weakness will intensify, leading to a recession later this year, despite a temporary delay due to the stronger-than-expected consumer spending. Ultimately, healthy consumer spending has been instrumental in keeping the U.S. economy from entering a recession. However, the question remains: how long can U.S. consumers continue to sustain the economy? Consumer spending has experienced declines in 4 out of the last 6 months, indicating a potential weakening trend. It's important to consider upcoming factors that could impact the economy further. The Supreme Court's decision on student loan cancellation, expected within the next 2 weeks, carries potential implications. If the court denies student loan cancellation, it will add more financial burden to U.S. families. Additionally, the debt ceiling agreement stipulates that student loan payments will resume in the third quarter, affecting 40 million consumers with student loan debt. This resumption of payments means less disposable income for individuals, which could have ramifications for GDP growth and the overall economy. In response to economic challenges in real estate and banks, the Federal Reserve has opted to pause interest rate increases. This cautious move aims to prevent further harm to struggling sectors. Balancing inflation control and economic stability remains a delicate task, shaping the central bank's decision-making process. Feel free to share your thoughts in the comment section below regarding the Federal Reserve's decision, the state of the economy, and your prediction on whether higher interest rates will be implemented later this year. That's it for today. Thank you for watching. Don't forget to like this video, subscribe to our channel, and ring that notification bell for more updates here on Investify.